Namaste, candidates. So, in this lecture, we'll dive into something that is super important, but it's kind of under discussed. And I think it's actually quite good that GARP has introduced this chapter in the new FRM Part 2 curriculum this year. So, validating bank holding companies' VAR models for market risk. So, this is MR chapter 6 for this year. Okay. Even though the title sounds all very formal kind of and very textbooky kind of title, but this is the stuff, I should say, that really determines whether banks are actually managing market risk the way they say they are. Okay, now before we get into the technicalities, we need to understand that it is not enough for any bank to just run a VR model. They need to validate that model. Okay, they need to make sure it is conceptually sound. It is actually reflective of risk. And of course, good enough to satisfy both the internal risk managers as well as the regulators. Okay. Now you might recall that in the first chapter, MR1, we learned how these models are built, right? We used things like parametric methods, simulation based methods. Okay. So we learned how to build such models. Even in chapter 2 and chapter 3, to some extent, we studied, not in chapter 3, sorry, not in chapter 3. Basically, the building of the model part was done mainly in chapter 1. And in MR4, we focused on backtesting. Okay, we checked how the models perform after the fact. But in this chapter, our focus will be before that. So it will be about validation, it will be about benchmarking, and in some way checking the robustness of the model. Okay, so let's try and explore uh, how how banks actually do that. Okay, and where they kind of fall short, and what kind of frameworks and what kind of tests are used to validate a VR model. Okay, so let's get started. So let's first see what we are going to cover in this session based on the GARP learning objectives. So first we look at some of the key things a bank needs to consider when assessing the conceptual soundness of its VR model, like model assumptions, risk factor choices, data inputs, etc. We'll see that. Second, we explore how to conduct a sensitivity analysis of a VAR model, what it tells us, why it is useful, and of course, the challenges that comes with it. Third, we talk about the common issues the institutions are facing when they try to calculate the confidence intervals for VAR. So there's quite a bit of nuance here actually, from data problems to distributional assumptions as well. And finally, we'll wrap up by discussing the benchmarking of VR model, uh, of VR models, in fact, why they are important, why benchmarking is important, why it is difficult, okay, and what kind of academic and regulatory in fact, what I should say, what academic and regulatory literature they suggest as practical solutions to overcome those difficulties. Okay, so let's get into it. Now, let's talk about something very important when we are validating a VR model, and that is its conceptual soundness. Okay, so is the model even built right in the first place? That is important. Okay, so let's start with the first point, theoretical foundation and assumptions. So, first up, of course, the model needs to have a very sound theoretical basis. It has to be based on some solid theory. We are not just randomly plugging numbers into Excel. Okay, there's got to be a solid financial and statistical foundation behind it, like say assuming normal returns or independence, and we need to be very clear about those assumptions. Okay, next we can look at risk factor coverage. The model must include all the biggies, I should say, the interest rate risk part, the equity risk, the FX, commodities, etc., you name it, anything, all these things have to be included. If you miss something major here, the whole VR number can be misleading. A third point under this theoretical foundation and assumptions part comes as parameter estimation. This is the third point. And when you are estimating things like volatility or correlation for that matter, you want to be using reliable statistical techniques. Okay, because see, they should be reliable, and ideally if you say they should be based on historical data that reflects actually how the market is going to behave or behaves. Okay. Okay, now we'll continue with the next set of checks. We have the uh, data quality and relevance under scope and representativeness of input data. So data going into the model, if this data itself is junk data, okay. So of course you know that garbage in, garbage out, right? So the data has to be accurate, okay, and actually reflect the bank's risk profile. That is important. Next up, data time horizon. This is the time window you will use to calibrate the model needs to include both normal as well as stressed conditions. Okay, stressed periods have to be included. You don't want a model that only works in calm markets but completely fails during a crisis. Granularity matters too. Like you want enough detail in your input data to capture differences across various asset classes. Okay, you cannot just lump everything into one bucket and expect a useful result. Then we get into model assumptions and limitations. Now, many VAR models they actually simplify things. Okay, like assuming linear instruments when they are actually not. Okay. Now, these simplifications need to be understood and they need to be stress tested properly. Then there is also the stationary assumption, right? The model assumes that the statistical properties stay stable over time. And this we have discussed a lot in part one also when we were discussing time series. So this is the assumption and also implied volatility. If you remember, we discussed these parameters with respect to their stability over time. But see, markets do not always behave that way. So this part has to be tested. And last you have, sorry, and then you have, yeah, then you have fat tailed and extreme events. So this is super critical. Your model has to be robust enough to handle market crashes, because if you're going to ignore tail risk, you're missing the whole point of market risk modeling. Now let's come to stress testing and scenario analysis. Okay, so we have robustness. Okay, it is very very important that if the market uh, goes wild, the model should be able to handle a bunch of historical as well as hypothetical scenarios. Okay, and it has to be completely robust. Very very important. So we use plausible high impact scenarios which are relevant to the portfolio. Next, we have sensitivity analysis, which is kind of like tweaking the knobs, and seeing how the output changes. Okay. So let's say if I slightly change the volatility or tweak the correlation matrix to some extent, does the VAR spike or does it stay relatively stable? No, this will give us a sense of whether the model is too fragile or it is reasonably robust. Okay. And then we get into back testing and performance validation. So back testing, as we all know, it is the classic way to check if the model is doing its job or not. So we compare the predicted VAR with the actual losses over time. And if the model says that there are only, say, 1% chance of breaching the VAR, there's only a 1% chance, then we should see exceptions only, or I should say roughly 1% of the time. Okay, because if we see more number of exceptions, that's a red flag for sure. And to get a bit more rigorous, we also, if you remember, we used to have in the previous chapter also back testing, we used to have conditional coverage test. Okay, so we run conditional coverage tests to check whether those exceptions are just randomly scattered or clustering is there at certain times, which can indicate deeper model issues if clustering is there. Okay, So this entire these techniques actually, particularly this trio of techniques, it helps you to see whether the VR model is practical, whether it is stable, aligned with real world market behavior. Okay, and also it allows you to test it at a very basic level. Okay, let's wrap up our list of these conceptual soundness checks with two two areas two areas, but really important areas. You will have integration. Okay, and the point number 8 will be governance. Okay, first let's discuss integration. So starting with integration into bank's risk management framework, uh, it is important that we think about practicality, because the VR model shouldn't just sit in a spreadsheet or in some regulatory report. It should actually be used. Okay, it needs to align with the best business practices, or the business practices of the bank. Okay, the model should support the trading strategies and the risk appetite. That is extremely important. Okay, now if suppose, if you check the outputs and you have the VR data, so VR should be able to inform decisions like risk limits as well as capital planning. Okay, that is very, very important. And this is where point number 1 is also integrated together. Okay, it has to be aligned with the business practices, and the VR should be able to inform decisions like setting of risk limits and capital planning as well. See, if the model itself is out of sync with how the bank is actually running its trading desk, then it's not going to be much of help, right? Now let's come to the last part. As I said, governance and documentation, and this is also very important. In fact, I should say this is big. The model has to be very clearly documented, how it works, what assumptions it makes, okay, what data it uses, everything. No black box kind of stuff should be present over here. Okay, it should be transparent, the documentation as well. Plus, there should be independent validation. Okay, like a separate risk or validation team that's not involved in building the model. This will keep things very objective and honest. Okay, so yeah, this is about the first part, considerations for conceptual soundness. So if the banks take all these 8 considerations seriously, they'll have a VR model that is not just theoretically sound but also practical, robust, and also defensible, because there will be instances, many occasions, where the bank has to defend the model internally as well as to regulators. All right, candidates, let's now look at the key steps in conducting a sensitivity analysis of a VAR model. Something that's not just useful but often necessary, I'll say, during validation exercises. So we start by examining how VAR reacts when we tweak position sizes. So if you slightly increase or reduce a holding, does the VAR change accordingly? Okay, it actually should. It actually should, because if it doesn't, then it's a sign that your model might be blind to actual shifts in portfolio risk. And of course, this kind of test also helps to uncover hidden or omitted risks. Things your model might be probably ignoring, but it should not ignore those things. Next, we break down VAR into marginal and component contributions. So, marginal VAR answers that if I nudge this position a little bit, how much will my total VAR change? Okay, because of a small increase. And component VAR actually goes a step further. It tells you how much a particular position is already contributing to the portfolio's VAR. Now, this decomposition is quite useful for risk attribution, because it tells you which positions are driving your risk and by how much. Then assessing the impact of omissions. So finally, omissions we are handling. Now these can happen, of course, if you are using proxies or pseudo histories, if you are building VAR of pseudo historical data. Now the key question over here is that, do these omissions materially affect your VAR estimates? And regulators, they take this very seriously. They often require banks to report what's called as RNIV, which we'll study later on. Okay. Risk not in VAR for exactly this reason, actually. Now, sometimes you simply don't have complete data, especially for illiquid positions or newly added trades. So, in such cases, you can use regression techniques to estimate what the impact of that position might have been. Alternatively, historical simulation applied quite smartly. Okay, it can be used to approximate contributions even when direct values are not available. Next point, the fifth point, estimating component VAR for omitted risk. Now, this is quite intuitive if you see. What if the VAR determining day had a position missing or an unreliable number, let's say? So here what you do, you try to estimate what the position would have lost on the specific VAR day. And if that single day seems like an outlier to you, then you use nearby scenarios, okay, to improve your reliability. So this gives you a better and more consistent risk attribution. Then the next point, impact of portfolio composition. So we should not forget that VAR sensitivity itself can change depending upon how the portfolio is structured. So in a relatively passive portfolio, the change might be stable, but in active trading portfolios with lots of turnover, the sensitivity profile it changes rapidly and your VAR should be able to keep up with that. Okay, candidates, let's just wrap this section. Let's talk about how sensitivity analysis feeds into model validation. So, this is not just a side benefit. In fact, sensitivity analysis ties directly into Jarrow's model validation framework, which is widely referred in risk governance. Many of you might be familiar in your jobs regarding the Jarrow's model validation framework. It allows you to test key assumptions, especially those surrounding omitted or underrepresented risk, the kind of blind spots that could you can say mislead a VAR model. And more importantly, it helps the banks to prioritize future improvements instead of overhauling the entire model. Sensitivity insights, they can tell you where the most critical weaknesses are. Okay, what to fix first. Okay, fine. Let's move on to the next part. Okay, so benefits of sensitivity analysis of a VAR model. Let's quickly walk through why sensitivity analysis is so valuable. Like, what are we even getting out of this whole exercise? So, first up, validating model assumptions. This is about making sure that those little shortcuts or simplifications you've made in your model are not secretly blowing up your results. Okay, so if you have skipped something, say a risk factor, then sensitivity analysis can help you test if that is actually okay or if it's a problem. So it will help you refine the pseudo history of value changes. Second, this tool is super helpful for identifying key risk drivers when you break down your VAR into component and marginal parts. Okay, you start to see which positions are the real risk culprits. Okay, so it helps to identify which positions are contributing most to risk. So it's like, hey, this position is contributing way more to the total risk than you would expect. And that's a big insight actually. Third, regulatory compliance. So regulators nowadays want more than just a VAR number. Okay, they want to know what is not in the model. The so-called risk not in the RNIV part that we had just introduced in the previous slide, which I said will be discussed later on as well. Okay, so sensitivity analysis actually meets supervisory expectations to quantify these omitted risks as well. Okay, so it gives you a clean, structured way to respond to that. So you are not just checking a box, you are actually giving the regulators some real analysis. And finally, model robustness. So this is where the model, I should say, earns its stripes. because by testing how the changes in the inputs affect the VAR, you're basically hardening the model. Okay, you're making sure it can still perform when markets go crazy, which as we know they love to go very volatile. Okay, so yeah, this sensitivity analysis is not just a nice to have thing. It is, you can say it is like the Swiss army knife of model validation. Okay, now since we have seen the benefits, it's also important that we see the challenges as well. Okay, so we have to be real. Sensitive analysis is powerful, but it is not always easy to pull off. There are a lot of challenges involved. So what is the first big issue? Data scarcity and proxy issues. Okay, so if you don't have clean data for certain positions, you might end up using a proxy, but the problem is that the proxy might be maybe less volatile or maybe not closely correlated. Okay, and which means that your model might underestimate the real risk. Next is computational complexity. So if you've got a big portfolio that is changing positions daily, okay, running multiple sensitivity scenarios every time definitely will eat up your time as well as resources. Third, interpretation is not always straightforward. Okay, so for simple assets, it's fine, but for complex assets, complex stuff like options or structured products, the relationship between position size and VAR is not linear. It's curvy, okay, non-obvious, and a bit of a headache to untangle properly. And there's the reality of dynamic portfolio, especially in trading environments. Of course, things shift so fast that your beautifully run sensitivity analysis could also become irrelevant tomorrow. So, yeah, the challenges are quite real. Okay. Now, to summarize, to sum up, let's just quickly see the key points in the sensitivity analysis of a VAR model. So, bottom line is, of course, that sensitivity analysis is quite essential, right? It actually lets you check whether your model is solid, whether risk omissions or say simplifications are throwing off your results, and whether the right positions are being flagged as high risk or not. So by decomposing VAR, we saw that we get to see which positions are actually driving risk. Okay, and we are able to make sure that we are not missing on anything just because some data was sourced or some data was proxied. And that said, of course, it's not a one-click exercise. It's quite computationally intensive. It takes time, it takes judgment, and it gets even more demanding when you're dealing with fast-changing portfolios, which is why banks need robust tracking frameworks, especially for risks that are not directly modeled in VAR, and there we talk about RNIV tracking frameworks. Okay, but if you get this sensitivity analysis right, you're building models that are not just smart but resilient. Okay, fine. Okay, let's move on to the next learning objective, challenges while calculating confidence intervals. So when we talk about calculating confidence intervals for VAR, things of course start to get a little tricky. Here's why, because there are numerous challenges. So first challenge is that you need to evaluate the probability density function right at the VAR estimate. Okay, and that's not as easy as it sounds. Okay, because financial returns don't behave nicely. We all know that they have got fat tails, skewness, and non-normal behavior. So, of course, if we assume normality, the intervals might be way off because assuming normality may be quite misleading itself. That leads to our second challenge, the choice of methodology. So there are two big camps over here. You have parametric camp and the non-parametric camp. Okay. So parametric approaches, uh, like the one Jorian suggested, they rely on theoretical assumptions and they use asymptotic standard errors. Okay. But again, if the assumptions like normality are wrong, your results won't be reliable. Non-parametric methods, they do not assume any specific distribution. Instead, they actually use historical data, which sounds quite great, but this choice also impacts the width and accuracy of the confidence interval, especially when markets are under stress. Now let's talk about order statistics. Basically, just sorting past returns from lowest to highest to estimate your VaR and the bounce. So the problem is that your past distribution will reflect future risk. Okay, that is the assumption. But it, of course, is not always true, especially when there are abrupt shifts or even normal shifts in the market. Okay. Then we have got bootstrap methods where you take samples from your historical data with replacement to build a synthetic distribution. Okay. So this helps avoiding assuming a shape or a distribution, which actually is good, but it comes at a cost. It is definitely computationally heavy. Okay, there are no strict assumptions, but it is computationally heavy, and it may not fully capture things like market dependencies or serial correlations for that matter. So calculating confidence intervals may sound clean on paper, but as we are seeing, we'll see in the subsequent slides also, in real world markets there are a lot of, you can say, landmines to look out for. Okay, then we have another major main point: data availability and the impact of market conditions. Okay, so many institutions just don't have the high frequency historical data that are needed to accurately estimate confidence intervals. Okay, so if your data set is too short, just like a few months or a single year, then you miss out on long term risk behavior. Your confidence interval might look tight, but they're not very trustworthy, you can say. And of course, during periods of market stress, things will get even messier. Like in financial crisis, the data that you collect during that time may not be representative at all. This could lead to confidence interval that are either too wide or too narrow sometimes, both of which will give you a false sense of security or even a false sense of stress. So this is where something called as filtered historical simulation, or FHS, becomes quite valuable in volatile markets. It adjusts for volatility and it tends to give you more stable intervals in rough market conditions. Then you have the fourth challenge. We should not ignore the computational costs which are involved. See, there's no one size fit all method for confidence interval. You have different methods. So whether you're using historical simulation or say GAR or say Bootstrap, each one will give different confidence interval results, and sometimes dramatically different. Okay, so if you are using GAR in particular, they are the confidence interval are typically narrower, which will indicate higher precision. Okay. Then comes the real world issue: computational burden. Methods like Bootstrap involve a lot of resampling and can be, you can say, a real time nightmare for trading, for large trading portfolios. Okay, some models require repeated simulations, which is just not practical for the firms that need fast intraday risk updates. Okay, now let's also discuss something quite important when we talk about confidence intervals for VAR. We often assume that they are nice and symmetric, right? Okay, but here's the reality: they are not symmetric all the time. In fact, most of the time, these intervals actually tend to be asymmetric, and as I said, mostly they are asymmetric, and more often than not, the upper bound is actually wider. Okay, that's because the tail risk, the kind of extreme loss we fear, is much harder to pin down. So the further you go into those tail scenarios, the messier the estimation gets. And of course, uh, this will become a very big issue because if suppose the upper bound of the model itself is off, you may actually underestimate the worst case scenarios. So a bank that thinks it's prepared for the 1 in 100 event, okay, it might just be exposed when things really go south. Okay, so that's why the understanding of the behavior of the confidence interval itself is super important. Not just the point estimate of the VAR, but the confidence interval of the VAR as well. Then we have computational complexity. Okay, this is the last challenge that we're going to discuss right now. So we can look at the regulatory expectations and something we call as RNIV, which I was saying earlier that it will be discussed, or risks not in VAR. See, here's what's puzzling. Most institutions still do not calculate confidence intervals for VAR regularly, even though supervisors are beginning to expect more structures around this. Okay, so there is no consistent regulatory requirement, and that's why you have inconsistent practices across the industry. Then there is the issue of this RNIV. Okay, risk not in VAR. Many banks just exclude certain risk from their VAR model. Okay, that is fine until a supervisor will come in and say, "Oh, what about the stuff you did not model, right?" So regulators now want the firms to track these omitted risks, and their risk management frameworks are actually quite robust. They should actually be quite robust. Now, with respect to this, the real world issue is that techniques like bootstrap or resampling techniques, they are actually powerful, but they are extremely resource intensive. Okay, and of course we have to be honest. If you are running a big trading book, running repeated simulations may not be feasible in real time in real time always. Okay, so there is a gap between what regulators want and what the firms can realistically do, and it is important to strike a balance between rigor and feasibility. Okay, okay, so now let's move on to the challenges in benchmarking of VR models, the next slide. Okay, so benchmarking VR models, what are the challenges? So we all know that banks spend a lot of time uh, in building these models, tweaking the parameters, running stress tests. But the problem is that very few, very few take the time to benchmark one model against the other in a formal way. Why does this matter? See, unless you compare your current VR model to an alternative, how do you really know it's the most accurate model or the most robust model, let's say, or whether it's too conservative or not conservative enough? Okay, so this is what we are seeing. We have to look at the key challenges that make benchmarking a very tricky kind of business in the real world. And these are challenges that many banks are actually quite struggling with. Okay. So since the banks, they don't really run a structured side by side comparison of their existing model with a new one, they might run the new model in parallel for a short while, but honestly, that's more of a formality than proper validation. So what ends up happening is they replace certain parts of the model as needed instead of evaluating whether the new model is actually better. Okay, so this makes it really difficult to judge which model is truly accurate or truly reliable. Okay, that is very, very important that the banks should make sure, okay, that this particular model is the most accurate or the most reliable or most robust. But if you have partial model replacements, it will make the job of evaluating performance improvements quite difficult. Okay, then we can talk about the next challenge, comparability. This is kind of tricky. Most banks, they do not maintain two VR models running at the same time for a long enough period. And even if they did, the models may be built on different assumptions. Like they may be using different data sets, different risk factors, or even different time horizons. Okay. So when you try to compare them, it's not apples to apples comparison. That's the problem. Because if one model is more conservative than the other, okay, or let's say it is tuned differently, the benchmarking results will not tell you the full story and it will lead to real discrepancies in the risk estimates. Then another technical challenge, I'll say, statistical testing. So ideally, we would use tests to compare model performance, right? But trading portfolios, they change a lot. Okay, which means that your data may not be independent or even stationary. So most statistical tests, they assume that the data is IID, independent and identically distributed. Okay, which may not hold in practice in the real world. Real world financial data rarely behaves like that. And if you are using regression based models to compare risk factors, those comparisons also can get messy because the underlying relationships will keep shifting, will keep on changing. So you can't rely on entirely on standard tests to tell you if one VAR model is better than the other VAR model, which will actually distort the test results. So as we were talking about resources costs a lot. Okay, so the same thing applies to benchmarking also. Benchmarking of course also takes resources. So to do a proper comparison, banks have to need have to they actually need to store and process huge data sets, and they need to run multiple models in parallel, often along over long time periods. And of course that is quite resource intensive. It utilizes a lot of computational power. So the banks may want to benchmark, but they probably don't have the infrastructure to do that in a meaningful way, because they have to have long-term parallel model runs, even computational complicated models as well. So complicated models have a lot of computational demands which may exceed the infrastructure capacity of the bank. So of course it's highly resource intensive, it's time consuming, and for smaller institutions especially, this is a huge barrier. Okay. Now this is interesting, this one. I think this is the last challenge in benchmarking VAR model, if I'm not wrong. And it's a bit ironic also. Why? See, we are talking about regulatory bias and conservatism over here. Sorry. Now, because of the regulatory scrutiny, banks tend to err on the side of caution, I'll say. So they end up designing VAR models that are deliberately conservative. Now, it sounds quite responsible, but here's the issue. See, when you benchmark these conservative models against something like a PNL based VAR, the PNL VAR often comes out on top. Okay, so the overestimation of this risk may actually reduce the model accuracy when you compare it with the PNL model. Okay, studies have actually shown that in most banks, P and L VAR actually outperforms the positional VAR. Okay, which basically means that the positional models are probably too conservative, which suggests that this is a costly approach. Okay, and see, your it's not just about being cautious, right? Your model accuracy itself, it's actually getting hurt. Okay, you're not getting necessarily better models because of lower risk taking. Okay, so these were the five big challenges that banks have to face when trying to benchmark their VR models. Now, in the next slide, we'll look at what can actually be done to deal with these issues, the approaches that banks can take to make benchmarking more effective. All right, candidates, let's now shift gears from discussing the benchmarking challenges to how we can actually address them. And one of the most effective ways is by using loss functions. Now, the core idea over here is that loss functions help us evaluate both the accuracy and the conservatism of a VR model. So we are not just asking, did the model predict the loss correctly? We are also asking, did it play safe or did it take on too much risk? Okay. Now, back in 1996, Lopez introduced a regulatory style loss function to formalize this. So the structure is quite simple. Okay, this is the regulatory loss function over here. Quite mathematically intensive if you see the expression, but the idea is simple. If the actual losses, if the actual losses exceed the VAR, it means that there is a breach, the model will get penalized. Okay. And that penalty is actually squared to amplify severe misses. But of course, if the losses are within VAR, there is zero penalty, no penalty at all. Now, here's the kicker. See, this setup clearly favors conservative models. Okay. It says you overestimate risk, fine. But if you underestimate it, that's the problem. So that's very much in line with how the regulators think. They prefer caution over optimism always. Because from a systemic stability point of view, underestimation of risk is the real risk, if you say. So this approach not only benchmarks performance, it also aligns with regulatory expectations, which makes it quite a practical and powerful tool for model validation. Now let's look at the second approach to benchmarking, statistical tests for model comparisons. So this one's about bringing some formal testing power into the mix. These two experts, Diebold and Mariano, they developed a statistical framework that allows us to compare the predictive accuracy of two competing models. Okay, essentially it lets you test whether one model consistently performs better than the other, not just by chance. Now, Sarma and his team use something simpler, the sign test, which is based on comparing the performance of models across multiple indices or multiple time periods. Okay, so the idea is to count how often one model uh, outperforms the other model without assuming anything about the distribution of error. So it's quite simple but effective. Now, both these approaches connect back to the loss functions. Lower average loss function values will suggest that a model is more accurate and less prone to underestimation. So when comparing models, you're not just eyeballing charts, you're also backing up with statistical evidence. The third approach takes a more grounded real world angle, using the profit and loss based VAR models for benchmarking. So instead of comparing statistical outputs or simulation results, this method actually benchmarks the model against actual profit and loss data. So why does that matter? Because it reflects how well the model performed in capturing real trading outcomes, not just theoretical risks. Okay, this is where GARC based or GARCH based models often come into play. They are dynamic, they are volatility sensitive, and they can be directly tested against the realized uh, profit and loss data to assess whether they are over or under predicting marketing risk. So benefit over here is quite clear. It is a practical check. Okay. If a model looks great on paper, but it cannot explain the P&L swings in a way that trader actually faced, then that's a red flag, of course. So this method pushes the benchmarking process closer to how the risk is experienced in day-to-day trading. The next approach builds on historical data but with a twist. We have seen this earlier. Filtered historical simulation, FHS, and it's basically smarter. It is more adaptive, a more adaptive version of standard historical simulation. So instead of blindly applying the past return data, it actually adjusts the data to reflect recent volatility conditions. Okay, so it means that it is much better at capturing current risk levels, especially during turbulent markets. Okay, this actually makes it incredibly useful when you're comparing VAR models across different time periods because it normalizes for volatility shocks that might be otherwise, distorting performance comparisons. So one way to do this is simply by applying the GARC 1, 1 models. They estimate conditional volatility, okay, which is then used to rescale the historical returns, which is essentially filtering the data to match the market today. Okay, so you still use historical returns, but you're using them in an intelligent way. And the final approach we'll explore in this section is based on a neat statistical trick, order statistics. Okay, it was introduced earlier also as the issue. And this brings a lot of value, especially when distributions get quite messy. So here's how it works. You take historical value changes, sort them from worst to best, and then use that sorted list to construct confidence intervals. No distributional assumptions, no fancy math. Just a clean, robust ranking. So this approach is especially valuable when the underlying data is not normally distributed, which is often the case as we discussed many times in financial markets. Fat tail skewness, no problems. Order stats, they don't actually care. And the big win is that it adds fairness to the comparison process. Okay. Instead of relying on assumptions that may not hold, this method keeps things grounded in actual observed outcomes. So it's a great tool to ensure robustness in your model comparisons, even under difficult real world conditions. Okay. And with that, we complete this chapter on validating bank holding companies value at risk models for market risk. So all the four learning objectives we have covered thoroughly. Okay, GARP FRM learning objectives. And this lecture is specifically for the GARP FRM part 2 exam only. Okay, now you're fully equipped on how financial institutions they validate their VAR models for market risk, particularly in the context of what is going to be asked in the FRM Part 2 exams. So we started by understanding how to assess the conceptual soundness of a VAR model. Okay, we questioned its structure, the assumptions and limitations. So see, we have seen a lot of things regarding backtesting as I discussed earlier, but there are a lot of ideas and some kind of formalities you can say which should be taken care of even before back testing, and it's better, and even post back testing if I may say, and it's better to develop a formalized structure. Okay, secondly, we explored how sensitivity analysis tests the model response to position changes. We identified the sorry by identifying key risks and highlighting any kind of omission. Then we tackled the challenges in calculating confidence intervals. Okay, regulatory issues, methodology limitations, all these things. And finally, we ended by seeing the benchmarking of VR models. Okay, why it is important, what are the challenges, what makes it difficult actually, and the five structured approaches that we have been proposing to overcome these challenges. Okay, so if you have followed along till here, you have covered some of the most critical, technical, and high value aspects of model validation, because this is a chapter which I said that it is new this time in the curriculum, and this kind of stuff is the stuff which often separates a good risk manager from a great one, I'll say, because this is something which is going very deep. Okay, so FRM candidates, stay sharp, stay very, very curious, and keep strengthening your fundamentals. And as always, namaste. See you in the next one. Thank you very much.